to this CLC series on the Construction Playbook. My name is Justin Sullivan. I'm the chair of the Construction Industry Council, and I'd like to welcome our speaker this morning, Nadia Buhova, who is Head of Financial Markets and Marketing Suppliers at the Cabinet Office. Today we're going to be hearing about assessing the economic and financial standing of bidders to safeguard the delivery of the public sector projects and programs. So some housekeeping, please pop your questions into the Q&A. We don't have the facility as panelists of seeing if your hands are raised, and also please note that this session is being recorded. So Nadia, over to you.
Good morning, everyone. Thank you so much for the opportunity to bring you a little bit closer to one of the most important policies within the sourcing playbooks. You would be here because of the obvious new playbook, which is the Construction Playbook. We're actually very close to publishing the second version of it. And I know a lot of you, judging by the attendees, are already kind of feeding your thoughts and feedback on the original version. So thank you so much. The one point I would say is the EFS policy, which is effectively assessing the economic and financial standing of bidders and suppliers, will remain largely the same. So don't worry, what I'm actually presenting you today is going to be relevant and still applicable in the new version, which aims to address new points of interest, such as ESG, net zero, and other reflections from the industry. If you could go to the next slide very quickly. Thank you. The objectives for today, I mean, you can see the agenda at the moment. So effectively, we're going to go very quickly through the principles of the policy and its context. I'm going to talk you through what we mean by financial due diligence throughout the whole commercial life cycle, what we effectively refer to as the actual procurement and then contract life cycle. So you would understand a little bit better how you would be assessed initially and then monitored throughout a contract. And of course, we're going to aim to have at least half an hour for your questions and reflections, so that hopefully I could address most of your thoughts today. And if we could move to the next slide, we could talk about the objectives. Hopefully that aligns with what you expect, but effectively, I'm aiming to improve your understanding about the policy context and the assessment principles from the perspective of yourselves as a bidder, but also get an insight about how the contracting authorities from a public sector perspective view this process as well. I'm hopeful to improve your understanding of what we're looking for when we assess the financial standing of a bidder, and most importantly, leave you with some reflections about how to increase the effectiveness of your bid information and how to present your financial performance information in the best possible way during a bid process. Thank you. I thought it would be very helpful to go very quickly through the commercial life cycle. So just to give you a kind of a bird's view of where exactly do we do the financial assessment. In most simplistic terms, the bidder's financial robustness is tested as part of the selection criteria, which is at the very beginning of a procurement process. Of course, it is informed by market engagements and other information about pre-existing framework agreements and contractual agreements that are relevant, or earlier versions if it is, for example, a contract that is being pre-let, or a project that is an extension of a previous one. So we do a financial assessment as part of the selection criteria, and it's very important to remember that you can't retest, you can't test again the financial standing of a bidder during the actual procurement process, but what you have to do just before the contract award is to ask the successful bidder to self-certify that nothing material has changed in their financial standing. At that point, if, for example, the bidder has released new financial statements or other information that provides us with the ability to test the original financial criteria again, we are allowed to do so. But again, it's the same test applied at the beginning just tested against new information, or effectively getting reassurance that nothing materially has changed since the point of the selection test and the point of contract award. And of course, the next point of financial analysis then becomes financial monitoring of the successful bidder, who is at that point a supplier throughout the life cycle of the contract. Hopefully, it's not required, but if there is a financial distress event throughout the life of a contract, then will be, as expected, additional financial scrutiny and additional activities which would have been most times pre-described in the contract in standard clauses and potentially tailored towards the specific situation. But as we know, it doesn't happen as often as hopefully we could have. Thank you. And if we'll now move on to the actual key principles of due diligence during the selection. And if any one of you has any burning question throughout this, feel free to pop it in the chat. And I've asked Liz in the team to kind of point me. I can't see the questions, but if there is something that's quite important to be addressed as I speak, we'll make sure that it's addressed. Otherwise, we can do it in the latter half of this presentation. But effectively, what we'll talk about is why we're doing the due diligence during the selection stage. So if we could go to the next slide, please. I think we can think about it as a trade-off. The contracting authorities have to make sure and assure themselves that the bidders that are selected and for further investigation, further assessment of their bids, and potentially shortlisted to be the supplier for a project, have to have the solvency as well as the competency to deliver this project and contract. In return, the contracting authorities have to make sure that the criteria against which we're testing the financial standing of the bidder is as clear as it can be. It's transparent and fair. And again, going back to the original point of a selection process as part of the procurement process is to ensure that this is a suitable bidder, this is a suitable supplier for the particular contract. It is actually an assessment of the supplier itself in contrast to your overall bid. And this is why it's almost like a gateway to the assessment of the bid, which is about your actual solution to the project. It is, of course, I'm sure we all have read a lot in the press recently, and since the case of Carillion, there is a lot of scrutiny and there is a lot of emphasis on the solvency and the financial robustness of our suppliers. And the key objective of this policy is to ensure that we are safeguarding the provision of public services and projects to the best of our ability. And of course, our EFS policy is in line with the wider procurement principles in the public sector, which are equal treatment of bidders, non-discrimination, and proportionality and transparency. Now, having that wider context in terms of the procurement, I just wanted to highlight that the EFS policy is in line with the public sector procurement regulations and the overall procurement regulations that I'm sure all of you have familiarized yourself with, and therefore some of the limitations and probably some of the areas that may come across a little bit restraining from your perspective, unfortunately, are limitations to us as well, and we have to abide by it. If we go to the next slide, please. Thank you, Liz. We could talk about the key principles. And the most important one, I think, is about appropriateness. And actually, we really focus on tailoring the EFS to the actual procurement and the project we have in mind. Considering that you have to find the best potential supplier for a specific contract opportunity, one of the key elements that we have to assess with EFS is actually the capacity of a specific bidder to perform the activities required on the contract. And you have to demonstrate this through a transparent method. The methodology that is used to assess the financial robustness of a supplier has to be absolutely transparent, objective, and non-discriminatory. It has to be clearly laid out in the procurement documents and provide you with the opportunity to kind of comment on it and be able to understand your performance against it. All bidders, regardless of their constitution, size, sector, have to be treated fairly and not disadvantaged by the nature of the tests or ability to apply a test on their financial standing. And I know this is a point that comes quite often, it's raised quite often from your perspective. And I know that we're doing our best to clarify it as the public sector policy owners to the best of our ability. And I'm happy to take any points on this later on. But for now, we can move on to the next most important principle in my view, which is making sure that you do see your assessment and you are given the opportunity to comment on it. And a very important EFS principle is that even if once you've seen your tests and you clearly see your result against this test, which is classified as anything but low risk, the bidders should be given the opportunity to provide additional information, an explanation as to why this test should not be considered as, the outcome of this test should not be considered as high risk, and therefore you're not kind of precluded from participating in further on in the procurement. You can procure with a supplier that with a bidder that has been assessed as high risk or medium risk on some of the tests, but it will be subject to acceptable risk mitigations that, of course, are considered and discussed with the bidder itself. Thank you, Liz. And on this slide, you could actually, the previous one that was just on, you can basically very quickly see that the selection evaluation process has 3 stages, and DFS basically sits very neatly as part 3 of the selection questionnaire, as part of this addressing the question of, is this supplier suitable? And I just wanted to mention that this is a very good and important point, because it's not just about assessing yourself as low, medium or high risk against our ratios or financial tests as they're defined in the selection questionnaire, but it's the opportunity to identify these mitigation actions that I've mentioned just a minute ago. And this is the opportunity for both the bidder and the contracting authority to kind of identify actions and things that could be mitigated, for example, through things as easy as monitoring throughout the contract. And again, it's very important for us that the DFS assessment is proportionate, flexible, and not overly risk averse. And later in my presentation, I will talk a little bit more about what we mean by this. And here I think it's important to remind again that pre-award, we can retest EFS with new information, as I mentioned earlier, and the contract signature is the point at which the actual supplier warrants their financial performance, and legally effectively is saying that you warrant your financial standing, which is deemed, in your view, sufficient to carry out the contract. Thank you, Liz. And if we go to the next point, and this is where it becomes a little bit interesting. I am aware that probably not all of you are accountants or finance specialists, so I'm going to make sure that it's not too technical, but if it does feel a little bit too patronizing either, and you don't think you're getting enough of detail, I'm more than happy to address more the kind of technical and detailed questions in the second half of the presentation. But what I want to show you here is what type of ratio analysis, what type of financial analysis we do as part of the DFS, what do we recommend as best practice, and also how do we classify, how do we go about, what are the key steps and principles that we follow in actual real life experience of EFS assessments. And I just wanted to add a small caveat that I'm sure a few of you are already aware. The playbook is a policy, and we do recommend a number of standardized ratios that we have predefined and explained and provided guidance in terms of what we deem as high, medium, and low risk. Every contracting authority has the ability and right to tailor them at other ratios and adjust their thresholds subject to their own analysis of the market and the needs of the actual procurement itself. Of course, for us, it's important to follow the principles of DFS, which means that you see the test in advance, you fully understand how you tested, and you are provided, most importantly, you are provided with the opportunity to explain your results and why they may have to be categorized differently rather than medium and high risk. If we could move on to the next slide, please. Thank you. So I know this is a very confusing diagram, but it is publicly available and you could actually see it in the public guidance about assessing the financial standing, economic and financial standing of bidders and suppliers. I'm not going to go through it in full detail, but I guess I wanted to illustrate that there is a step-by-step process that you go through to identify what is proportional for this particular project. The most important thing is it has to be proportionate for the actual procurement. And I know that some suppliers may say that if they're quite prominent across the board, they may want to use the same assessment they've used on another contract, but because of the public procurement regulations, we have to stick to assessment which is procurement specific, and therefore we need to assess what is deemed proportionate and what is sufficient for actual project on its own. And this is basically how we go about this, and we basically apply a contract tiering risk assessment. We're trying the decision tree diagram shows the steps required to identify whether that particular procurement opportunity is gold, silver, or bronze, and this is effectively the risk classification of what we deem, how critical we deem that procurement to be. If we go to the next slide, we're going to bring a little bit more detail to it. So as expected, gold is effectively the most critical type of a contract that we have in government and the wider public sector. Often it is about its value, but not only. We do use a contract tiering tool that help us identify these categories, and the key principles that we go through are the contract value, but equally, actually, and more importantly, is the complexity of the actual procurement. Has it been outsourced or procured before? Is it something that is quite typical, for example, in the construction sector? Is it another hospital that looks very similar to something we've done before? So actually the design and the construction is very similar to something we've done, and therefore the risk of delivery is probably lower than in the previous case when we're trying to deliver this. What is the complexity of the payment mechanism, and what is our ability to reprocure? And I think we're all aware that in construction, it's not as easy to find someone to kind of substitute and step in as it may be in other cases due to a legal health and safety restrictions and regulations. But the other element of how we assess the risk on contracts is, as I said, value so far and complexity. But the last one is risk itself. You have to basically you have to do a risk analysis on the impact of a contract failure, and that could include, of course, an insolvency of the actual supplier, the public perception of the contract. Is this a contract that could be particularly sensitive for the public? And of course, in more recent years, the sensitivity of the data that is associated with this contract. Maybe that's more for digital and technology contracts, but of course, it does have its importance for construction as well. Again, gold stands for something that is usually quite large, but not only. Monetary value is important, but not the only decisive factor. It's how long this contract is. Is it very complex? And of course, what are the critical works and services, and what's the impact on the frontline delivery of public services? Silver is actually still a very important contract, but probably not as critical for public services, or it wasn't deemed as risky as gold. I know that the example here is printing services, but it could be more, actually, it could be even more complex contracts by this, but they're important rather than critical. And then, of course, bronze is smaller contracts, relatively simple, easy to replace a supplier, and certainly not critical for the frontline services and operations. And that could, in most cases, it's kind of back office, one-off supplies. We could move to the next slide, please. Before I go into the actual ratios we recommend using, I just wanted to provide a little bit of a background of what do we use, what type of information do we usually use to assess the financial stability of a supplier. And as prescribed by the procurement regulations, we are focused on publicly available information, something that you should be able to readily supply to us. The initial and most poignant focus is on the bidder and the parent's financial statements, publicly available accounts, effectively. We are talking about profit and loss accounts, balance sheet, cash flow statement. And the important point here to note is that to enable equal treatment of all the bidders, we have to focus on the reported numbers as a starting point. That would mean that we take into account prior adjustments, exceptional items, including non-cash items as a starting point, because we have to take the reported statements as they are, as a starting point for equal treatment of all the bidders. In addition, we would be looking to critically and important information already available in the public accounts. I'm sure you're all aware of the increasing importance of the auditor's reports, including a going concern, which I'm sure we're all familiar with the fact that they're getting even more rigid than they have been in the previous years. So we do pay attention to material uncertainties or significant audit matters, and of course, the existence of a clean audit report. We would pay attention to internal controls and risk management as outlined in the accounts, and we would be looking for qualitative insight from publicly available information, particularly provided in the notes of the accounts, and other information provided in the reports by the CEO and the CFO. In certain cases, and where deemed necessary and acceptable, we would use management accounts and forward-looking information, such as cash flow forecasts. However, I want to stress that in most cases, this is secondary allowed evidence. So the starting point is always publicly available financial statements. And the usual practice, which we recommend in the selection questionnaire document, is to outline if for some reason the financial statements are insufficient or either very old, older than 12 months from the point of assessment and publication, so therefore the going concern assessment is already outdated, or it's insufficient, it doesn't have a profit and loss account. We do provide a list of secondary information that is deemed sufficient, and then the bidder itself can pick and choose from this list of secondary information and provide what is kind of appropriate for them, and they could provide additional information as well. It could be management accounts, it could be cash flow forecast, but as we know, if you're a listed entity, you clearly wouldn't be in a position to provide this. If we could move to the next slide.
Nadia.
Yep.
We just have one question.
Please.
It's a pretty long one, part of the statement as well. Whilst the mechanisms are based on proportionality and appropriateness, how is this reconciled when lawyers drafting contracts for public clients seek a worst case level playing field across all potential suppliers with enhanced protections with costly guarantors and bonds? Should those enhanced protections only be specified when not at a low risk supplier as mitigation, or through the contract when there is a material change to a supplier that moves them from low risk?
Thank you for that question, and hopefully we can talk through some of the available mitigations, which is later on in the discussion. I think in this particular case, it's very important to kind of recognize that sometimes additional mitigations and protections for the contracting authority may be required because of the actual nature of the contract itself, rather than purely because of the financial standing of a supplier, and that will be a cumulative kind of assessment of the risk profile, and it will be clearly articulated. we recognize that sometimes it might appear excessive and clearly not articulated in terms of rationale. But the protections in these mitigations, in most cases, are particularly when the supplier is deemed as high risk or sufficient financial risk. So you're right that in most cases it is about actually addressing the financial risk of the bidder. But there are a few cases where the actual complexity of the contract, let's say it's a first generation, particularly complex outsourcing comes to mind in this case, when it is required just because it's an untested territory. But it should be an exception, and I take that point. Is there any other?
Yeah, we also have another one. How do you address the risk of publicly available information and financial statements being not timely in light of COVID and other shocks undermining the ability to rely on this historic information?
Absolutely. And this is why we have this list of secondary information as well. And as I said, we do have a bit of a rule of thumb. If this, we do rely on going concern assessment, which is on the point of actually it's meant to last for at least a year from the point of signing the accounts rather than the actual period of the statements. But of course, we do strongly encourage the bidders to provide us with additional information, particularly management accounts, and more recent information about their covenants and leverage. So this is the reason why the starting point is financial statements in line with the procurement regulations, but we do provide a list of additional information that we aim to kind of get from the bidders. And I strongly encourage you to actually provide this as well, because otherwise we are encouraged to come back using this additional, effectively, even if we just focus on the financial statements, we are absolutely entitled to come back as part of the selection phase of the bid whilst we're assessing your financial standing and come back with more questions about your financial standing in the light of more recent events. And of course, if we are changing and adjusting this approach, there would be a there will be a procurement policy note to specify this. But we are trying to be as flexible as possible, and we would require collaboration from the bidder as well to provide that more recent view, especially when the accounts are quite old, as you rightfully pointed out. Hopefully that was a sufficient response for now. I think I wanted to just mention about these ratios, that our ratios are actually quite prudent. Most of these you would have come across in your day-to-day life, or for those who are actually doing financial analysis or finance as their core job. Most of them are quite generic. They're also quite often, for example, net debt to EBITDA is a leverage ratio used by lenders as a covenant test. But we probably add a lot more elements and items to it, as identified and outlined in the EFS public guidance note, where we explain these elements. And we're very clear that the starting point may be stark, because we also use the reported numbers, but we are eager to listen in terms of how you adjust it or how you report your covenant tests. And we're trying to listen to you in terms of leaving it to you to kind of provide us with adjustments to the calculation, and for us, which we may deem necessary. So most of these focus on, I mean, the turnover ratio is actually part of the procurement regulations, and it's about assessing your capacity. Are you big enough to deliver that type of a contract? And it uses either the revenue, your total revenue, or your asset base compared to the annual revenue under a contract. Then the operating margin is, of course, whether you generate sufficient operating profit, and whether you're not as a bidding entity. It's very important to mention this is focused on the actual financial statements of the bidder and the parent, not necessarily the management accounts or the kind of the financial statement, the financials that are required to deliver the actual contract itself. This is about you, as it's assessing the standing of the entities. As I mentioned, we have leverage and interest cover, which again, these are ratios very common in the market, because they're covenants. We have asset ratio, net asset value, and which are again very generic tests of the balance sheet, just whether you're in a net asset position, whether you have positive equity, and of course whether you have what's the proportion of your current assets versus current liabilities. So it's a proxy of assessment of your working capital. The group exposure ratio is a specifically public sector designed ratio, which aims to understand the exposure of the entity delivering the contract and its dependency, financial interconnectedness with the group overall. For example, is it underwriting group debt, or whether there is a lot of dependencies of intragroup kind of payables. And if we go to the next slide, please. Very quickly, we have a very special tool, which I'm sure most of you are familiar with. It's called Financial Viability. It's Financial Viability Risk Assessment Tool. It's currently we are at version 4.3.1, and it could be it's accessible on Gov.uk, and it's effectively, this is not a policy, but it's a tool to enable the implementation of policy. It aims to show you how your ratios are assessed, and it helps kind of bring both the contracting authority and the bidder at the same page in terms of the information, the input of the information, and how the ratios are assessed. And of course, that's a good tool through which you could explain, and you're provided with the opportunity to explain your ratios. You see your results as you populate it, and you could explain it and provide further information. If you could go to the next slide, you could very quickly see effectively what happens is you populate, at the moment it's 3 years, again, in line with the procurement regulations, 3 years of financial statements. So you could see some historic trends of performance. You see the conclusion against these ratios and against the regional threshold. So actually it would have been made very clear as part of this document what is deemed acceptable for this procurement. You would see your results, and you'll be provided with the opportunity to kind of explain very quickly or provide more information of why this shouldn't be deemed as the final result for that bidder. If we go to the next step, this is where we address the mitigating actions. So as already kind of touched by in the commentary and the questions, once you've seen the results, those who are actually the bidder that is deemed between, let's say, low risk and medium risk, in most cases they wouldn't attract further mitigations. But if, as part of the assessment, it was considered necessary and appropriately, we have a range of mitigating actions to be deployed, and that ranges from having proactive monitoring, and as part of your contract you would have a regular kind of provision of further information, and you would be retested every year against the original tests of the procurement to kind of provide additional information, especially if there was something that required further monitoring from your performance. It could be liquidity, it could be leverage. It's something which will be specified. It could be open book contract management. In some cases that could be deemed necessary. It's for the contracting authorities also to ensure they have contingency plans for critical contracts, and that's now part of our business as usual approach to this type of contracts. And they have to reassess regularly what are the alternative suppliers, timings, and potential disruptions, and how to mitigate these. It could be a parent company guarantee if it's deemed necessary, for if the bidding entity itself seems is deemed that it doesn't have enough capacity to deliver the contract, then a parent company guarantee might be deemed an appropriate solution. And very common mitigations for construction, which I'm sure you're familiar with, are performance bonds and project bank accounts. And project bank accounts are probably becoming a little bit more popular, considering the increasing cost of performance bonds and potentially its underutilization. So I think it's always a negotiation at that point, in the sense of it's based on the evidence you've received and the information that the project team has received about the procurement, and it's kind of decided taking into account the financial performance and what is deemed necessary for the risk specific to this procurement. Again, it's very important to talk about the risk profile of the actual procurement that we're discussing. And if we could go to the next slide, which hopefully would help with some of the questions. I think my biggest tip to bidders is that what we've seen so far is such a uneven quality of information that we've received. Quite often, I think the people who populate the financial, the EFS part of the bid are not always finance colleagues as well. And you could tell from the narrative that was added that it wasn't necessarily someone that had a very detailed understanding of the accounts or the performance of the business. And it's almost, at times it feels like an afterthought as well. And that complicates things because you absolutely know how dynamic the procurement assessment period is. And if you want to, this is your perfect opportunity to provide all the information and explanation of why you shouldn't be deemed as high risk. And I absolutely strongly encourage you to really utilize that credible narrative and that opportunity to explain both why certain ratios are red. It could be we've just completed our refinancing, we've just had an equity raise. Actually, we just haven't had recent accounts for you to see the improved performance. And you could supplement this with either narrative management accounts or something that is deemed appropriate for your organization. You could always use your covenant tests as well. As I said, we're very prudent with the way we calculate net debt and EBITDA, and therefore your covenant test may be another way to demonstrate the same ratio. You could tell us, well, actually, I'm not going to trigger any negative actions on my debt arrangements because I meet my covenants, and you could explain that to us. You could always talk about exceptional items and one-offs and why they should be treated this way. I mean, this is a very low-hanging fruit that quite often feels underutilized by the bidders. And then offer other mitigations, as kind of touched on as someone who's already fed a question. If you feel that you're going to be asked for something that you don't feel ready to offer, well, offer mitigations that you deem useful for you as a starting point for discussion. Talk about the fact that you're happy to give us ongoing monitoring, to provide us with management accounts on an ongoing basis or something. I think it's important to be proactive in this particular period of the procurement process. And any additional information that is deemed allowed from your organization could be particularly helpful. Any information about your available liquidity, for example, credit lines. Is it a committed, is it an uncommitted facility? What kind of facility do you have? How long does it take? Does it cover the period of the contract? Of course, the parent trading update. If your parent is a listed entity, would have way more regular trading updates and public information than your bidding entity. So anything that could be of use to demonstrate that you have the financial standing, I think the onus should be you should take a proactive action rather than wait for the contracting authority to come back with questions. Knowing where they're coming from with these ratios, I think a reasonable finance colleague would know how to populate this and reassure the contracting authority. Very quickly, because I recognize I kind of overrun slightly, very quickly, if you go straight to slide 19, if that's okay. How do we carry out financial monitoring? Once a bidder has been successful and has gotten the contract, effectively what we do throughout the life of the contract is that we keep monitoring our suppliers, particularly suppliers delivering gold and silver contracts that we deem critical and important. We continue retesting the supplier against the original ratios that we had as part of the procurement, but we also use wider financial information available to us. We would be obviously paying attention to the market and compare kind of performance against peers to get a better sense and benchmark of what we should expect a supplier to do. We, of course, are doing our best to use available information such as operational delivery, just to bring more context to what we do, to kind of the performance. Is there something else that we need to be taking into account? Market trends, macroeconomic trends. I mean, clearly we're all focused on wider shocks such as inflation, material costs, and etc. So it's really trying to kind of bring a holistic picture of not just the original test, but also looking to the wider market and sector. And we use government networks. We talk to each other and make sure we understand and kind of share supplier intelligence to make sure we kind of stay aligned, and we work with you as well. So as you know, our City in Markets and Suppliers, we have a fantastic program of partnering with strategic suppliers. So we make sure that we understand the performance of our suppliers, and we help and educate and improve capability across government in that respect as well. What happens when we don't do it effectively, or what happens when, for example, the supplier has not reassured us sufficiently? If you go to slide 20, we'll cover it very quickly. It's very important to have a partnering and a discussion with our suppliers, because if there are signs of distress, we would investigate. But if you, sometimes, of course, the suppliers are trying to kind of prevent negative reaction from us, and where there are concerns about the financial health of a supplier, if there hasn't been sufficient assurance from yourself, for example, you could explain some of these signs of distress by providing us with more information why we shouldn't treat it as such. But if we don't get that reassurance, of course, we have to basically up our monitoring. We have to discuss internally with stakeholders across government that are specialists in managing special situations, distress, and where necessary, effectively, we escalate. Basically, the contracting authorities escalate quite often to my team in the Cabinet Office, and we work collectively in assessing risks. But I do think the most important part in such a situation, if there is a sign of distress, is to work with the supplier, rather than we're absolutely not there to make things worse for each side, which is at that point, the most important thing is collaboration, access to information, and an ability to work together to manage risks. And at that point, I would love you to ask any questions. Thank you so much for listening today. I've added some comments, that kind of the links to the public documents, and I've added an email where you could provide any feedback and ask further questions.
Fantastic. Thank you, Nadia. That was really interesting. We don't have any more questions in there, but I do have a couple for you. Maybe a bit cheeky they are, but one of them, I noticed on slide 15 that it said 5% operating profit is an unacceptable risk, 5% or below. That would exclude most tier 1 contractors, wouldn't it, in the UK?
No, apologies. This is just a generic. So in the financial, apologies, I should have rectified this. For construction, is actually 2%, and that was my personal. That's my personal. I've adjusted this a year and a half ago. We aim to have different thresholds for different sectors, and unfortunately, the one on this slide was generic and for complex outsourcing and digital providers. So apologies, that was not the ones we have for construction. So
is it out of interest? What would it be in construction? Would it be 2? Or
yeah. So actually, we would deem low risk if it's above 4%, but 2 is when we start. At that 2% is when we start, asking questions, and we'll deem it as high risk. But at that point, you could come and explain to us why. Again, we do take into account no cash impacts, impairments, so we probably have a lot more diligent view and calculation than the one you would use. And we recognize it's a low margin sector. We absolutely recognize that. So we just want we welcome, of course, clarifications and information from the actual supplier to make sure that, there is enough cover there.
Thank you. Sorry to put you on the spot there.
No, it's a really good spot. Thank you. You paid attention, Justin. Thank you.
I was. And another question, we've got a question in there. Well, I don't know. Another question from me is, how do you think this suits SMEs? Because that's the majority of our sector, isn't it? Just listening to what you said there, it did look reasonably straightforward for a government policy, because traditionally it used to be boxes of information that had to be filled out. They were in the people's mind, were they, when they were creating this?
I think it's an interesting question. It's so the playbook is a set of principles, policy principles that we've tried to address in tangible steps. And the financial viability risk assessment tool, the FERA, it's a bit of a mouthful, I know, is trying to kind of, I know it does have a lot of entries to fill, but it's currently, hopefully one day we're going to have a proper system that joins up and you could all see it in one place. But for now, the spreadsheet is the best. It's the model, actually, it's not just spreadsheet. it allows you to kind of pre-populate everything, and you could see how you come out in these boxes. But then it's not meant to be a black and white test, as I was trying to say. There is always a nuance, because we absolutely rely on your disclosure of additional information to kind of reassure us that that's not, as I said, we don't look just in the ratios, we look into your account, we look into your accounts and notes, the wider context, both of the kind of the group, not just the bidding entity, but also the parent. So it's a lot more holistic view of the financial standing of an entity than just 8 ratios, if that's helpful.
No, that's very helpful. I think I've set a couple of hairs running with my comment about tier 1 contractors' profit margins. There's 2 comments, an anonymous attendee saying that public councils think all their projects are silver and gold, so they might need a bit more guidance where margins are low, and that the bronze may not be a factor to consider, which I think you've answered that, Nadia, when I mentioned earlier. And the second point is, there's another question from Vaughan Bernard saying 2% is for profits only when the contractor is ability to remain cash positive with low levels of investment. I mean, this is more of a statement, and I agree with Vaughan saying the supply chain profit increases as you go down the chain, and that's interesting. As for overheads, they should be at least 6% of the main contractors. Suppliers can require as much as 30%. They're interesting points, Nadia. I don't think they're questions for you.
No, I think what I want to add here is, I think I don't want to come across as us being overly simplistic. And again, we try to we assess the risk of the procurement in question, and therefore we do actually take note of the supply chain, and we make sure, as part of the payment mechanism and the transparency and visibility that we retain of the supply chain, that there isn't a disproportionate level of profit. As you know, we are guided by managing public money principles, such as, value for money for the taxpayer. So we do our best to kind of take into consideration the supply chain and ensuring that they're paying sufficiently, but also that the overall group, of course, the profit on a contract is proportionate. And that should be clear. We do also I didn't mention, but actually on certain contracts, we do test the supply chain as well. So they're also tested against the same ratios.
Sure, and I know tier 1 do that. They test down more than one level, don't they? They go down to level 3 often. So there's a point here being made, and I must say, in my day job, I run a surveying consultancy, and the point is how can, with the impact of COVID, war, huge inflation, how can a construction company warrant their future financial performance? The accounts, the public available accounts, are going to be from some time ago, aren't they? They'll be from the previous year. And it's a great point, anonymous attendee, we don't have your name. To answer that as a quantity surveyor is we're seeing a lot of stuff going cost plus, so the procurement route is changing so that the inflation costs are picked up by the client or shared. But I don't think you can guarantee that. I think we're in an unusual time, Nadia. I don't know if you have a view on this.
Well, yeah, of course, I hope this is not an argument, stop procuring with small companies. But let me not be too cynical about this question. Of course, we recognize the high level of uncertainty at the moment. And as I said, we do our best to kind of stay close with the sector and industry leaders and sector specialists we have in government to kind of understand the macroeconomic shocks and risks impacting suppliers. When it comes to accounts, as I said, there are various ways of managing this risk. Quite often we ask for management accounts as well, especially where the public accounts are old. And as I said, we have a rule about this. There is a rule of thumb: if they're outdated sufficiently, we have the right to ask for more recent assessment, liquidity forecast and assessment, and kind of reassurances. And this is exactly the point at which you may actually have to ask for further mitigation. We also do our best to kind of manage our partnering with suppliers so that we have early visibility. And as you know, we do have mechanisms, contractual mechanisms, standard and tailored to address and hopefully manage and share the risk where it is appropriate.
And that's, even down into the smaller, the SME outside of government work, they do the same. They ask for management accounts. They ask to have a closer look at covenant and see how it is. And then the Carillion word has been mentioned here, which I'm not surprised by. So financial competency of people and organisations is not an internal state of grace, as another point by Vaughan has been made. Yeah.
No, of course. Well, I think it's a fact that inevitably, I mean, the government did step in and provided a lot of support during the pandemic, and we do see a little bit of a catch up in terms of the level of insolvencies we see compared to the pre-pandemic levels. And this is not just in the UK. You see France and the UK closing the gap with pre-pandemic levels, but that's more of a catch up of companies that obviously were artificially held. But I think it's fair to say so far, I think we've learned a lot of lessons from Carillion. I do think the quality, capability, and internal controls within the public sector has greatly improved, and you could see the playbooks. It's a fantastic outcome of this. Hopefully we have learned a lot of lessons, and we're doing our best to mitigate risks. I'm hopeful that the organizations we deal with, our suppliers, have learned their risks as well. And I see a lot of the organizations managed to refinance during the pandemic, and there was a collaboration, some rational behavior, which I'm hopeful to retain in the current ongoing uncertainty.
Thank you, Nadia. And I think another point to make is this is just part of the construction playbook. There's other areas of the book which tests procurement and auto procurement, and Vaughan is on it. What's the key lesson learned from Carillion? So I don't know. Do you want to answer that question? You can duck it if you like, because that's a really tough one.
It is a tough one, and I think I could always use the fantastic excuse of it's above my pay grade. But I'm sure you could see that there is a lot more visibility about our policies and processes. We've made it very clear what our standards are, and we actually do apply them. We manage a lot of organizations more rigidly. We have improved capability, and I do think that the way we procure at the moment is certainly in reflecting of the lesson of what happened with Carillion, and I'm sure we all can see that.
Sure. Okay.
Thank you.
Great. No, Nadia, thank you. So we're a few minutes early. I've got to say the one of the statistics from this session is the attendance rate has been amazing. So we started with 40 and we've got 42. So that we didn't bore them, or you didn't bore them, which is great.
Fantastic. Well, thank you so much. I hope that was helpful. And as I said, we're more than happy to address any feedback and queries that you have. I'm more than happy for you to share my team's email address. We have a fantastic team in-house that collaborates with the policy playbook team as well. So we are happy to answer any questions you may have or reflections. Thank you so much for the opportunity to talk to you today as well.
That's great. Thank you so much, Nadia. Thank you, Lawrence and Liz, for facilitating, and look out for further CLC sessions and series on the playbook. Have a great day, everyone. Thank you.
Thank you.